But let's bring in Unlimited CEO Bob Elliott to kick things off. Bob, it's great to have you here. I mean, S&P 500, it looks like up 0.4% today, 47.74. I mean, when we started the year, did you think that we would end here up 24% on the broader market?
I think few people thought that we were going to get to that point over the course of the year. Even I, who was pretty bullish on economic conditions, thinking that we were unlikely to get a recession, was surprised that there was the magnitude of easing that we then saw in the last quarter of the year that's really driven this last leg higher. But when you see what's happening with the Treasury and the Fed taking steps to ease the tight monetary policy that had existed before, you've got to go with it. That's a great situation for stocks. The economy's still strong. Monetary policy and long end is easing. Those things add up to being bullish stocks, particularly relative to the bond market.
So for 2024, is it a don't fight the Fed mantra again?
Well, it's the Fed and the Treasury who have both taken the steps to really rein in any concerns about an era for higher for longer. And it's true. It's an environment where you don't want to get in the way of that liquidity production that the Fed and the Treasury are providing and somewhat committed to provide. The real question is whether you want to be thinking about bonds in that context. I think stocks, it's relatively clear, but bonds are a little more concerning, particularly when you see all those cuts that are expected to come in 2024.
So in light of that, does 60-40 make sense in 2024? Or are you thinking about it differently?
Well, I think 60-40 in general, you continue to be very concentrated in stocks. And just because it looks like there's strong momentum in the stock market and weak momentum in the bond market heading into 2024 doesn't necessarily mean you want to give up on that diversification. You might look for other opportunities to find that diversification. We've talked about gold plenty over the last year, and it's held up well relative to bonds. And so you may see that gold looks a little bit better as a diversifier relative to stocks as we go into 2024.
I love that you brought up gold because that's exactly what my next question was for you. And that's the fact that it has been a good year for gold, whether it's inflation starting to come off or yields finally, coming back off a little bit, the geopolitical aspect of all of this and the uncertainty. That means the fact that central banks have been buying more heavily in gold, too. Are these fundamental drivers that continue into 2024?
Yeah, I mean, you make the case well for all the different things that are supporting gold. We've had a real stepwise move in terms of the gold price relative to interest rates over the last couple of years as those geopolitical concerns have crept in, and central banks that have been concerned about holding U.S. dollar or European denominated bonds look for other assets to hold in order to protect themselves and their reserve assets. That's shifted the level up. The second question is then what happens with interest rates and inflation in that context. And there, gold has continued to benefit from the fact that we've had this weakness in interest rates, and probably the combination of the two things. Certainly, if you think that bonds would be a good diversifier in 24, you should really be thinking about gold, given the complex that it brings, particularly on that geopolitical tension in the event that it increases.